everyone. Welcome back to another episode of Policy and Profits. I'm Anthony Esposito from Ascalon 6 Capital, joined today again by my good friend and head of economic analysis. What are you actually now at Heritage, EJ? What's the official title? I don't want to mess that up.
The titles don't matter, but it's chief economist.
Titles don't matter, but I'm the president of everything. EJ, good to see you again. So happy to have you back again, or have you back joining the show after the stint in your nomination for the BLS. Let me ask you a question. What do you think about gold?
I love it. We talked about it. Gosh, Anthony, I think the first time we were talking about it in terms of saying like how much we really loved it was back when it was like $1,800 or $1,900 an ounce, if I remember correctly. I think it was under two, right? It was under 2K.
It was under two.
And I think one of the things we had talked about was that now infamous Wall Street Journal headline saying gold is no longer a safe haven. Right. And I think at that point it was probably only like maybe 1,700 and change.
Yeah.
And boy, were they wrong. And since then, I've continued to be a strong advocate for it. It might be a bit overpriced right now. Maybe we do get, a little pullback from here. We've already seen that, a couple times now after hitting or setting new record highs, right? We get then the following day a small pullback. But I mean, look, gold is a great inflation hedge. If you take, for example, the S&P and you inflation adjust it, not just with the CPI, but with the price of gold, you see that it's basically flat over something like half a century. I mean, gold is really one thing that you just can't lie about. You can fudge the numbers in an inflation index. You can't fudge the numbers when it comes to gold. Now, gold does, admittedly, though, have some things working for it other than inflation right now. You have the fact that central banks have been buying it at an absolutely torrid pace. Another thing we had talked about quite a while ago was the fact that when we seized those Russian assets, and look, this is not justifying anything Russia did in the Ukraine, but when we seized all of those dollar-denominated Russian assets, a truly unprecedented move, something we've never really done before, it caused a lot of nations to realize that their dollar-denominated assets are not necessarily safe. Yeah. And that their central banks would rather hold an asset like gold instead of dollars. And sure enough, that's the move that we've been seeing since then. The result of that has been a huge increase in the demand for gold, a huge increase in the monetary speculation surrounding gold. In other words, unlike other commodities, whether it's copper or tin or lead or palladium, even some more precious metals like platinum, you have this monetary premium on gold. In other words, people are always wondering, are we going to return to convertibility? Mm-hmm. Which is where I can take my paper dollar and I can exchange that for actual physical gold, something that everyone could do until FDR made it illegal. And what we're looking at right now is a renewed resurgence in people's appreciation, I think, for that precious metal, specifically because of the disastrous inflationary policies that we've witnessed over the last 5 years or so. And it's not just here in the United States, although it certainly was bad under Biden, but a lot of nations around the world did the exact same thing after 2020. They spent tons of money they didn't have, and they simply printed in our case, the dollars, in their case, whatever paper currency they have, they simply printed the fiat currency to pay for it. And the result was a huge devaluation. Gold's a great way to protect against that.
Yeah, definitely hyperbolic on the debt and printing side. There was a Zero Hedge post on X, which you reposted. And I want to talk about the dollar for 1 second specifically with you. Then we're going to go into a little bit of technical analysis and charting in gold. Talk to me a little bit about this. And where do you see the dollar going? There's a ton of talk about the dollar on the fade, the de-dollarization effort with the BRICS across the board, which is a real thing. If I look at the dollar, I would say that the dollar right now is probably mid of range for the past 50 years as far as its valuation against a basket of global currencies. I'm using the DXY as my index to match the dollar against that basket. And I kind of see it near par. It's about at 98. It's been up at 115, 110 for the past couple of years. It's on the fade now. We've seen it down at 70. We've seen it up at 150. So it's really mid-range. Where do you see the dollar fitting into this, and where do you see the future for the dollar?
Great questions, Anthony. One of the things that we always got to remember when well, let me back up and say it's easy when you're pricing things other than a currency because you always use the currency as your measuring stick. And so even if that measuring stick changes, that your yardstick becomes shorter or your yardstick becomes longer, the relative values between item A and item B, that relative relationship doesn't change, right? If you, let's say item A is twice as long as item B, you can measure it in miles, you can measure it in feet, you can measure it in meters if you're a communist. And whatever happens, that 2-to-1 relationship is always going to remain. You will always have twice as many units measuring B as you did A because A is twice as long as B. Okay. Now, when you're trying to evaluate currencies, it becomes a little more complicated because now you're trying to evaluate those measuring sticks, which are changing. And so when we look at the dollar relative to other currencies, it becomes a question of who's devaluing their currency faster. And unfortunately, we still have, I think, a lot of voices here in the United States, both within and without this administration, who are actually happy to see, for example, a dollar devaluation because you do, in under those circumstances, you get a temporary boost to exports. This was one of the things that helped exacerbate the Great Depression. It wasn't the only cause by no means, but it did help exacerbate it and keep it going. That when you got into the 1930s, you had competitive devaluations around the world, and you increasingly had countries decouple their currency from gold. And so everyone, in a desperate bid to help boost their own export markets, they kept trying to devalue their currency faster than their trading partners did. And the result was everybody got poorer.
Yeah.
And unfortunately, you're seeing that to a lesser extent today, where again, you do have those voices pushing for currency devaluation. You also have the big spenders who are looking to devaluation in order to finance all of those runaway deficits that they want to keep going, and they're pushing it back against the folks who are trying to unwind that deficit spending. So, at the same time, though, right? The dollar is, I think, still the cleanest dirty shirt in the laundry, if you will. You're seeing a lot worse conditions around the world in other countries. And so even if everything is not sunshine and rainbows here,
Yeah.
you still have a lot of very positive developments, much more so, again, than in those other countries. The growth of stable coins and using treasury bills, for example, as backing there is helping to absorb a lot of the record treasury bill issuance that we're seeing right now as we try to refinance the debt and roll over some, I think, 10 or 11 trillion dollars this year. So it's not as if the dollar is in free fall. It's not as if the sky is falling. You do have a lot of negative pressures, I think, that are moving in the wrong direction. But at the same time, again, the situation is far better here than I would say in most other places around the world.
Yeah, I think that's a great point, and I'll just kind of put it into my terms. But that's a fantastic point, which people don't realize. If you look at the value of a stock, it's the value of a stock. The price of Apple is the price of Apple. When you look at currency, currencies are always valued relative to other currencies. There's never an absolute value for the dollar. It's the dollar yen, it's the dollar pound, it's the dollar kiwi, but it's not the dollar. It has to be priced relative to something else. And to
Mm-hmm.
your point, I think that that's a really important point to understand that there is a de-dollarization effort. There is massive inflation. The dollar is at risk as far as its value. You can see that. However, if you look at what's going on around the world, that free fall, or that kind of those pressures down on the value of the dollar may or may not be as significant as the pressures on other currencies. So the dollar may actually hold up better than we would think, because like you said, which I love, it's, what'd you say, the cleanest dirty shirt in the laundry?
Yep,
I love it.
exactly. If you're in a desperate moment, you're like, oh no, I have no clean clothes left, and you dig through the laundry pile to see which shirt is the least dirty, and that's what I'll have to make do with today.
Oh my, you start smelling armpits as you're getting dressed. So the next thing, so let's take a look at the dollar, right? And let's talk a little bit about what it's done, the technical breakout. We've been on this. I've written about this in the morning report. You've been on it 100%, and we've had a lot of discussions about it. If we look at the monthly chart of the dollar, I have one going back to 2010. There's a couple of important points here, and this is basic analysis, but it's a beautiful chart. It makes it easy, and we've removed a lot of the noise by going from a daily or a weekly even to a monthly. Um,
Hmm.
you could look at 2100 as really a resistance level back to 2011. We kind of topped out there and created really a massive base between 1000 and 2100. Came back up towards 2100 in 2020, still struggled to get above. And then two things happened in March of 23 and then in March of 24. In March of 23, from this chart, what I have laid out, you had the MACD, so the momentum, one of the momentum indicators that I use of many. MACD actually went positive, positive zero, and positive MACD to signal. So that was a big move. And remember, this is a monthly chart. So this is a slower moving ship. When things shift on the monthly, it's very different than things shifting on the 20-minute, right? This is much longer term. It's showing a real shift in strength. It's showing a longer term shift and a more sustainable shift in strength to the upside. In March of 24, we had a beautiful breakout stick, literally open on the low for the month, close on the high for the month, which was the breakout above 2100. That moment was a key moment for gold. And that gold has continued to push through. The third point I would make on the chart is I have the Bollinger Band set up here, standard Bollinger Bands. The gold has from that point on ground into and pushed through the upper band throughout from 2024 through this month. A lot of people look at the Bollinger Bands and that standard deviation move from the mean as a reversion indicator, meaning as things hit the top band, people expect it to revert back and get back to the mean or lower. It's not how I look at them. It's not how they work. When you see something breaking out and the technical indicators are lining up to the upside in this case, and
Hmm.
then you see price pushing into that upper band and continuing to push through that upper band, that's actually a bullish sign for me. And it's been a bullish sign on this monthly chart for gold since the breakout in 2024. Really interesting, really well orchestrated move in gold. Makes perfect sense with the inflation story and everything we've seen back to 2000, but especially 2010 here through 2025. There's some real tailwinds here for gold. If you look, I actually posted on December 26th of 2024. This is my morning report, which is typically just S&P cash, just to keep it simple. But I actually made a note on gold here as gold was breaking out above 2,600. So if you look in deck of 24, so just to the right of in the previous chart on the tail end, the last year and a half or year of the monthly, I noted that breakout above 2,600 at that point, in particular on the daily chart, which we don't have here to pull up, but the daily chart formed a beautiful wedge, a bullish wedge. We were breaking out of that wedge. Weekly and monthly momentum was strong and bullish. We were bullish on the push into the upper band of the Bollinger. That looked like it was going to continue. And then again
Hmm.
on the daily, break out of that wedge with momentum confirming. It was a beautiful move. And I wrote that on December 26th of 24 that move was good for at least 200 to 300 points to the upside. Continued to mark that up. And then we broke out from 3,000, which was, again, another leg up in that bull move. So we've seen this coming. What are the reasons for it? So in my view, we have geopolitical risk, which is, I mean, it goes without saying, we've had massive geopolitical risk over the last 20 years, but more recently, as we've seen this real breakout, we had 21, 22, Russia, Ukraine. We've had massive
Hmm.
risk in the Middle East with Israel, Hamas, Israel, Iran, U.S., Iran.
Yeah.
There's a lot of turmoil in the world, even domestic turmoil, social turmoil, which within Western Europe and the United States and Canada. We've had a lot going on. That's a real tailwind for gold. There's been massive inflationary pressures as far as the amount of debt that we have, our deficit spending, the way the Fed has managed monetary and balance sheet policy has all been supportive of gold. And then finally, one thing that I'd like to point out, which people don't typically look at, I actually mentioned this earlier in the week on a Newsmax show, the real yields on the 10-year. So we have a quick chart of the real yields on the 10-year. And I'd really like to get your take on this as well. If we look at this real yield, The real yield on the 10-year, meaning the inflation adjusted yield. So now we're back to inflation. We're back to the dollar. We're back to that tailwind. You're getting 1.8% in real terms on a 10-year bond, right? So if
Hmm. Hmm.
you're looking at it saying, well, the yield's 4.1-ish%, but in terms of an inflation adjusted number, you're actually at 1.8%. That lower yield, which by the way is down about 30% from the peak in late 23, 24, which is when this most recent leg up in gold started. That real yield is down about 30% at 1.8%. That's not really supportive of buying bonds. You're not
Hmm.
actually
Hmm.
protecting yourself against inflation. Where would you be protected against inflation? Well, to your point, gold. The last thing I would say real quickly is the incremental buyer of treasuries, the incremental buyer of debt has stepped away, i.e., sovereigns like China, like India, and they have pushed hard into the gold market. Um, could that be a canary in the coal mine? I think it could be. I think there's
I see what you did there.
I think there's a reason to think that. But
Hmm.
you like that, right? That you're a quick fella. Um, I think that those sovereigns pushing in addition to investors and banks and larger buy side funds, there's been a push away from treasuries, away from debt, and into gold. Uh, and that's kind of my spiel on gold. I want to flip back and go to this chart again and just ask you to wrap up my long-winded rabbit hole on the technicals. Um, where do you see this play in real yields? Because it's something most people don't talk about, but it is very important in the price of gold. How do you see, and do you agree with me that these real yields at 1.8% are a tailwind for gold and look like they're going to continue to be?
Yeah, Anthony, I think that's an absolutely fabulous technical analysis. And again, when we start pricing things, in terms of inflation adjustment, when we start pricing things in gold, as opposed to these different government made up metrics like the CPI, which we're not even getting right now, but frankly, who needs it when a third of it is imputed? In other words, we're guessing because we don't have the values.
Yeah,
Some bureaucrat is just filling in a spreadsheet with little more than educated guesses.
yeah,
And again, gold has risen far more dramatically, not just in the last year, or the last couple of years, but over the last, half century or whole century. Gold has risen much more than the inflation indicators would lead us to believe. And so I agree that investors really need to be thinking about inflation protection. They really need to be evaluating just how much of their returns are real versus inflation, and it's particularly troubling for folks when they I think when you're trying to do this whole calculus, you got to keep in mind things like the fact that your cap returns are not going to be inflation adjusted. You're going to pay tax on inflation gains, on just mere paper gains, not actual increases in real wealth. This all has to be going on in your thinking, or your investment professionals
mm,
thinking. If they're not thinking about it, find a new investment professional, right? You need the kind of inflation protection and tax protection that's not going to see your very small real gains wiped out. Right. We have to be thinking about real gains, inflation adjusted gains, and what we're doing again on the back end to protect ourselves from the tax consequences. Because again, the government's not looking at the real gains, which is what you and I care about,
right.
right? We care about the real gains. What can my future money actually buy me? Not just how much future money will I have. What can it buy me?
Mm,
What's my standard of living going to be based on the cost of living in the future? Government's not looking at that. They're just looking at the nominal dollar figure.
yeah.
So again, I think you raise really, really great points here, talking about those yields, because investors got to keep all of this in mind. And if you're not starting with the right numbers to begin with, Anthony, as you well know, if you have a false sense of what your nominal yields are, let alone your real yields, I mean, good luck ending up with enough money when you decide it's time to stop working
Yeah.
and you want to retire.
Yeah, no, it's those are great points, and the tax consequences are fantastic points. We have a very distilled portfolio here at Ascalon Six. Gold is one of the main players in that portfolio. In the managed future space, there's only five assets in the portfolio, which are run through a proprietary technical analysis program. It's a momentum trend program, which has been extremely successful and actually is more successful when volatility spikes and we enter that high vol bear regime market. Makes money both ways, but that's kind of the way this thing works. Gold being a major player in that portfolio has been a major benefit to the portfolio performance and numbers. I think it'll continue to be. We're obviously long short here in the future space, so if gold ever presents a signal to be short, we'll be there as a manager. I'll be there, but in the meantime, that signal has pretty much been pinned for the past 12 months and continues to perform well. And everything that we're saying away from the technicals really suggests that the tailwind for gold will remain. There may be consolidation, there always is. There may be some movement and some volatility within the move, but overall, lower left to upper right seems to be the direction for gold, and I don't really see that changing anytime soon. So
But I love the point you made, Anthony, right? That with Ascalon 6, that look, you can make money when it goes up, you can make money when it goes down, right? This is not so basic a formula as we just simply buy and hold, right? You're not managing money by simply throwing money at an asset class and then just hoping that you do continuously and constantly get that bottom left to upper right movement that you just talked about. So as the technicals change, I know I've seen you do it in real time, and the model says that you have to change those positions. I've seen you do it, and I've seen you make money again, whether you're talking about upward movement or downward movement. I think that's something really important, because so many times I can't get over how many even fund managers that I talk to, where the only strategies they have is simply buy and hold.
Yeah, it's definitely, look. Part of that mantra on Wall Street for me and the money management, asset management side has always been a sticking point. We definitely pride ourselves on the fact that we're not buckling up and jumping into a foxhole with some long-term protection that we've held when things get bad to hope to outperform. So markets down
Hmm.
30, we're only down 27, and we want our investors to be happy. That's not what we do. I would to give a visual. To give a visual, do you remember Forrest Gump, the movie?
Hmm. Hmm.
Do you remember when the storm hit and Captain Dan climbed out to the top of the crow's nest as the lightning is striking and the rain is coming down and he's screaming up at God and he's got no fear of that storm?
Uh-huh.
That to me is the Ascalon 6 portfolio as it's hitting the fan. We have no problem climbing up to that crow's nest and screaming quite a bit and taking it on, because that's just the way we're set up. We're not set up to buckle up and hide and hope things are okay and
Hmm.
say over the long term, don't worry, you're going to take a big hit now, but over the long term, you'll be okay. For us, timing is everything. For us, we're able to make money up and down, and you can throw up moves and low vol, you can throw down moves and high vol at us. We're going to be set up to succeed. I believe in the portfolio. I believe in what we do here, and I'm very happy to move forward with that as we build this fund out. So all good stuff, and appreciate you pointing that out, EJ. I truly do. And you have seen it. That is true.
Yeah, absolutely. My pleasure, Anthony.
Have a great week. I'm in DC next week, by the way. So I'm going to shame you into a public invitation for lunch, coffee, early supper, whatever on Wednesday. Just let me know if you're available. And I would love to
Love
see
it.
you, but I'll
Let's
be
do
in
it.
DC. All right, awesome. I will see you then. I will hold you to it. In the meantime, have a great weekend. Thank you so much. Always a huge ad speaking to you, getting your perspective, and in particular perspectives on the tax consequences, the dollar, and inflationary pressures. It's obviously front and center, and no one better to speak to except EJ and Tony. Thank you, buddy.
You're too kind, Anthony. Pleasure's always mine. See you next week.
Talk to you soon.